Happy Monday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. And we begin as we usually do with the economy. Today's episode will be very economics focused. China's consumer prices fell in February for the first time in 13 months, underscoring persistent deflationary pressures. A nightmare scenario for Beijing policymakers if it cannot be reversed. Yesterday, Sunday, the National Bureau of Statistics reported that the Consumer Price Index, CPI, declined by 0.7% from a year earlier, marking a sharper drop than the 0.4% forecasted by economists. While the steep decline was partly influenced by seasonal distortions, analysts warn that weak domestic demand remains a critical factor. Zhang Zhiwei, president and chief economist at Pinpoint Asset Management, noted bluntly, quote, "China's economy still faces deflationary pressure. Domestic demand remains weak." End quote. The Statistics Bureau attributed the unexpected fall in inflation partly to the timing of the Lunar New Year, which occurred earlier than usual in 2024. The holiday, which typically sees increased spending on travel and food, fell entirely in February last year, but started in late January this year, affecting year-over-year comparisons. Despite this, Goldman Sachs economists observed that even after adjusting for seasonality, inflation remained among the weakest levels in months. The NBS, National Bureau of Statistics, estimated that consumer inflation would have risen 0.1% from a year earlier if not for the holiday distortion. However, not all analysts agree. A particularly alarming trend was the drop in core CPI, which excludes food and energy prices. The metric fell by 0.1% in February, the first decline since 2021, and only the second time in over 15 years. Factory prices were even worse, continuing their downward trajectory as well, with producer prices falling for the 29th consecutive month. David Chu, an economist for US-based Bloomberg Economics, expressed in a note yesterday, quote, "China's weaker than expected February price data highlight slack demand and an urgent need for policymakers to deliver on pledged stimulus quickly," end quote, adding, quote, "Without a powerful boost from fiscal and monetary policies, deflationary pressures will continue to weigh on the economy," end quote. In response to these economic challenges, Beijing has set an ambitious GDP growth target of around 5% for 2025. We unpacked this across 2 episodes last week. The government also lowered its inflation target to around 2%, the lowest in over 2 decades, signaling an acknowledgement, at least, of ongoing deflationary risks. As we discussed last week, however, analysts are divided on how effective this will all be. After all, it's been years of policy now which have failed to arrest the deflationary spiral. To stimulate domestic consumption, authorities have rolled out policies such as 300 billion yuan, $40 billion program to subsidize appliance purchases. Additionally, the government announced 4.4 trillion yuan in special government bonds for infrastructure projects and 1.3 trillion yuan in special central government bonds, although some analysts noted this was slightly less than anticipated, and once again it is unclear whether this will have the desired effect to reach what is a very high growth target. And of course, as we've discussed as well, this is no doubt going to be driven by surging debt. The coming months will be critical in determining whether these measures will reinvigorate consumer confidence and economic activity. March's inflation data will provide a clearer picture of whether China's economy is stabilizing or slipping further into painful and difficult to reverse deflationary territory. Let's end part 1 with several observations made today by Peking University Professor of Finance Michael Pettis. Quote, "When you combine this deflation data with Friday's terrible import data, which showed imports for the first 2 months of 2025 down 8.4% in US dollar terms and 7.3% in RMB terms, it will be hard to argue that 2025 has started with a consumption bang. We'll get the debt numbers on Friday and the retail sales data the Monday after that. These should give us a better sense of whether or not consumption has started the year strong. So far, I don't think we should expect too much. If consumption doesn't pick up in 2025, and if export growth remains low, although until the US gets serious about its trade deficit, I suspect it will be higher than many expect, China will only be able to achieve the GDP growth target this year with a surge in investment. But investment where? We might see a small revival in property investment, and while there will be enormous pressure to keep increasing investment in the manufacturing sector, that will only worsen the trade conflict and reduce value of that investment. That leaves investment in infrastructure. I suspect that if we don't start to see much better numbers on consumption by the middle of the year, we can expect China to announce new infrastructure initiatives. End quote. Next up, we continue with the difficulties in the Chinese economy, but first, a sponsored feature. Sponsored features are limited to just a few a month to ensure that the channel is financially sustainable, but still primarily supported by subscribers. I put a lot of thought into which sponsors to work with. If you'd like to know how I work with these sponsors, these details are in the description below. As we all know, we are living in very interesting times. In this great time of change and uncertainty, many turn to gold. Indeed, gold has hit over $2,900 an ounce at an all-time high in dollar terms. The GLDG index, which aggregates junior mining gold stocks, sits at $51, compared with $167 in 2011, when gold peaked at $1,925 an ounce. Today, the spot price is 50% higher, while the index is down more than 69% from its peak. And on top of that, today's video sponsor, Gold Mining Inc., trading on the New York Stock Exchange, is trading within a few cents of its 5-year lows. Gold Mining Inc. is acquiring and advancing gold projects in the Americas. As of today, March 10th, Gold Mining Inc.'s market cap is $162 million, with no debt and $130 million in cash and equity holdings. Yet, when the company originally acquired their dozen gold projects, the peak combined market caps of the companies that held them was approximately 850 million Canadian dollars. The peak market caps were calculated based on each respective company's peak share price during the period prior to acquisition. This is where the opportunity is for savvy investors looking to take advantage of these trends. In August of 2020, Gold Mining Inc. hit $2.72 a share when gold first reached the 2,000 an ounce mark, yet the stock is now 68% lower. The value proposition is intriguing at today's stock price of 82 US cents per share. Once accounting for gold mining's cash and publicly traded stock portfolio, the company's dozen gold properties, aggregating of 12.5 million ounces of gold equivalent estimated mineral resources in the measured and indicated category, and an additional 9.7 million ounces of gold equivalent estimated mineral resources in the inferred category, are valued at only $10 million US. See the company's website for details of individual resource estimates and particulars of underlying technical reports. There is a gap between its market price and asset portfolio. Gold is trading at all-time highs, while Gold Mining Inc. is near its COVID-19 lows. What's more, this is a management team consisting of industry veterans with decades of experience in the industry that speaks for itself. Amir Adnani is the founder and co-chairman of Gold Mining Inc., along with the president, CEO, and a founder of Uranium Energy Corp. He advanced the company from concept to US production in its first 5 years, and is now one of the largest uranium companies in the public markets. David Garofalo is the co-chairman and director. Before joining Gold Mining, David served as president and CEO of Gold Corp Inc. Gold Mining Inc. presents a speculative play, high risk, but also a potential very high upside. As such, Gold Mining Inc. is worth considering due diligence on for any savvy investor. We remember that all investment involves risk. This sponsored feature is not individual investment advice. Always speak to an investment professional and do your own due diligence before making any investment decision. A big thank you to Gold Mining Inc. for sponsoring this episode of China Update. We now return to regular China Update content. Over the weekend, US-based Bloomberg published a good report discussing a theme we have followed for some time on China Update: why China needs to change its growth model, and how Beijing has become increasingly aware of this need. For decades, China fueled its economic rise by selling goods to American consumers. However, with the Trump administration now reimposing tariffs, raising them to 20% on Chinese imports, Beijing policymakers now aim to shift the balance by encouraging domestic manufacturing. Simultaneously, Xi Jinping is being forced to address one of China's most pressing economic challenges: reducing reliance on investment-led growth in favor of domestic consumption. This very much folds into the first development which we covered today. As Neil Thomas of the Asia Society Policy Institute, speaking to the outlet, observed, quote, "Boosting consumption helps Beijing to reduce its economic reliance on external demand in an era of rising geopolitical uncertainty following Trump's return to the White House," end quote. However, transitioning to a consumption-driven economy is much easier said than done. Consumption accounts for only 40% of China's GDP, significantly lower than the 50 to 70% seen in advanced economies. Meanwhile, investment, particularly in infrastructure and manufacturing, still constitutes an unusually high share of economic activity. To truly drive consumption, Beijing must undertake difficult structural reforms, including raising wages, strengthening the social safety net, and reducing reliance on state-driven investments. Yet powerful vested interests within the party pose a significant obstacle to change. Leaders of state-owned enterprises accustomed to subsidies and investment-driven incentives wield considerable influence over economic policy. Unlike in the US, where policy debates unfold publicly, China's internal power struggles remain behind closed doors, adding complexity to the path towards reform. If viewers will forgive double-dipping with today's episode, I would like to turn once again to Peking University Professor of Finance Michael Pettis and his observations on this challenge from the last few days. Quote, "We might get a 2 to 3 percentage point rise in the consumption share of GDP if there is a revival of household confidence, and Beijing is certainly betting on reviving household confidence. But I'd argue that any such revival is more likely to be a consequence of rebalancing than a cause. And even if China raises the consumption share of GDP by 10 percentage points, it will still be among the lowest consuming economies in the world. A bigger and more sustained increase will be extremely hard to pull off. This would require a major transfer of resources from either the government or from businesses. That's the problem. Transfers from the former require significant political changes, and transfers from the latter require reversing the whole productionist orientation of China's economic model, including undermining its global manufacturing competitiveness. The point is that China's extraordinarily low consumption level is not an accident. It is fundamental to the country's economic growth model, around which 3 to 4 decades of political, financial, legal, and business institutions in China have evolved. Changing this will not be easy." End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.